Thinking about doing a bit of spring cleaning to your investment portfolio? At ETF Market Insights, we got you covered. Check out these exciting episodes curated specifically for the DIY investor. Special guest speakers and insightful industry experts will provide you with the information and education you need to confidently manage your own portfolios. You won't want to miss these shows. Check out etfmarketinsights.com for more information. And don't forget to subscribe to our YouTube channel and hit the alert button so you never miss an episode.
Well, hello everybody, Larry Berman here, and note to self, don't have Frank's Red Hot sauce as a dinner meal on your chicken nuggets before you go live, because it's just not a good idea. But with that in mind, this is a very, very exciting and hot and spicy discussion tonight. We're gonna talk about traditional fixed income and alternative ways of getting yield. So, you know, BMO in their partnership with us is going to talk about a couple new ETFs that they have in the alternative income space. So we've got Mark Webster who's going to join us in just a minute with that. And we've got another guest tonight, Cynthia Maisonneuve from CMLS. CMLS is a alternative fixed income provider of mortgage-backed securities and investing. And we're going to dig into that too as we go back and forth and look at traditional fixed income, inflation, recession. So it's going to be a great night, probably my favorite, and this is the last one of the series. So again, thanks to all our partners who helped put this event on, and really special thanks to BMO Exchange Traded Funds. Without our partnership with them, events like this and our road shows, when we go back to doing live road shows, although some of the feedback from folks is that they much prefer this to live events. So we'll keep that in mind. I certainly don't mind not traveling all over the country as I get older. It was a lot more fun when I was the younger version of myself, I guess. Folks, many of you have made donations to one of our charities. As you all know, these events are free to everybody. We ask that if you're getting something out of it, if you're any benefit at all, or if you're just philanthropic at heart, please, in one of the links that we're going to send you out tomorrow with a copy of this presentation and the replay, there'll be some links there. Please make a donation to cancer research at Sick Kids Hospital, or dementia and Alzheimer's research at the Baycrest Center and Foundation Hospital, both here in Toronto. So with that in mind, I'm going to bring on our first guest, Mark Webster. He's by far my favorite BMO expert in the way of ETFs, and just a general great guy. We have such fun when we're on the road together talking about, you know, getting old and the facts of life and everything else. So with that, Mark, I'm going to go camera off. I'm going to turn it over to you, and please educate our folks on some alternative types of ETFs that BMO just came out with.
Well, thank you very much. ETFs have been around for an awfully long time, and during that time we've had declining interest rates, surging equity markets that some would say are richly valued, maybe a little more fairly valued today than they were a few months ago, but nonetheless we're in a late cycle, and all this has driven pension plans, large institutional investors, and even the likes of us to look a little bit more succinctly at what we're doing in our portfolios. Many years ago, we had a notion of something called a traditional pension portfolio, which was 60% stocks and 40% bonds. That was actually hatched in the 1980s when interest rates were multiples of what they are today. And that type of asset mix is no longer feasible or desirable in this type of in this type of environment. And that's where alternatives have come in. They now form a very big part in a lot of institutional portfolios. If you read the financial press, you'll often read that Canada Pension Plan, OMERS, the Caisse de dépôt in Quebec, BCI or AIMCO in Western Canada, very large provincial pension funds have gravitated enormously into alternatives. And they've done that because of lower interest rates, but they've also done that to diversify their portfolios away from these traditional stock and bond allocations. A big part of that appeal for them is that a lot of these alternative assets don't mark to market. So the market can fluctuate, and they're thinking more on the downside here. And they won't necessarily see those things reflected in their valuations because they don't mark to market. When we look at those types of solutions, we really have to be humble and realize that we can't do what the Caisse de dépôt or Ontario teachers can do. When they go into these alternatives, they go in as direct or co-investors with another large pension plan. They do their own due diligence. They model the risk to see that it meets their needs, and they place their money right away. The rest of us have to do this through pools of some kind. And even if you look at $5 billion, $10 billion pension plans, they go directly through pools. And the pools represent a little bit of a difference. We'll get into that a little bit later. Why alternatives have come to the fore. It's an opportunity to put real assets next to securities like bonds and stocks. Real assets we refer to as being infrastructure, real estate, commodities, and gold. And the reason I put gold in a different category, gold, strictly speaking, is not a commodity, because a commodity is defined as an asset that can create an income, that you can create an income from. There are no real widespread industrial uses for gold, and so it can't be used to create an income source necessarily. A lot of people try to wedge crypto into here as another form of alternative asset. That's an entirely different discussion we'll leave alone. The other part of alternatives is something called private assets, private debt, or private equity, and we'll talk about that a little bit later on. But as you can see, the change in portfolio construction between 1991, when you could have met your required rate of return 100% through bonds, through today, where you see portfolio construction become far more diversified, many more asset classes, some with some unique challenges. Larry, can you go to the next slide, please? Now, one of the things that I mentioned, the difference between the very large provincial plans in Canada and the rest of us, when they do this, they do their own due diligence. They place their assets themselves. They don't do it through third parties. One of the things we have to understand is investment management is a highly technical, highly arithmetic or mathematical approach. Big pension plans often refer to benchmark returns to gauge whether a manager is skillful or lucky. The difficulty when you get into this realm, be it physical real estate, physical infrastructure, private equity, or private debt, we don't have any universally agreed benchmarks. As a result, when we go into these pools, we end up with something called manager risk, and that is that manager may or may not be able to recreate the return stream that we hope, given their idiosyncratic holdings, which cannot be measured against, a benchmark or yardstick or anything else. The other thing is that these assets are normally very, very illiquid. They prevent the asset manager from deploying new assets. They have capacity constraints. You can't just go out and buy a new building or buy a new bridge or airport or toll road. You can't just go out and find new sources for private debt or private equity. There's an awful lot of due diligence going around in the private area. The information is not publicly available, so you have to scrutinize it very, very carefully. And so when we've had discussions with our institutional clients, we've seen a lot of them looking at our ETF suite and using ETFs with publicly traded instruments as proxies for these private or liquid alternative exposures. And we see that in infrastructure, real estate, private equity, and private debt. The ETF has several advantages. One of them is that an ETF is fully transparent. You can see what you own and understand why you want to own it. You can do your own due diligence on the securities underneath in whatever index happens to be packaged inside of that ETF. The ETF, because it's based on an index, is fully scalable and fully liquid. It gives you daily access to either buy more or sell part of your holding or all of your holding, rebalance your portfolio, deploy new cash, whatever you think is important. And this is why a lot of institutions have started to look at ETFs to bridge that gap between the traditional stock and bond portfolio and a more diversified portfolio using physical assets or alternative assets. If we look at the next slide, please, if you don't mind. I mentioned one of the things that you face when you go into a pool is something known as manager risk. Now here, we've taken the step to work with Brookfield. Now Brookfield is an interesting company. They have enormous strength in a very narrow focus. So they're very strong in both real estate and infrastructure. They have a global reputation. If we look at the table of ranks of Canada's foremost institutional asset managers, they actually rank number 4 on the list, which is rather remarkable because they only do 2 things, and that's infrastructure and real estate. But their expertise is so great that they actually have a global footprint. And we worked with them. We brought they've given us access to 2 of their disciplines. One of them is a renewables infrastructure fund, and the other one is what we call a new economy or technology-based tech fund. Both of them are interesting because, you know, we talk about alternatives. These almost form a bridge between a traditional alternative infrastructure or real estate exposure, but also to some degree also capture the growth spirit that you would see in private equity. And I say that because if we're talking about renewable energy or we're talking about technology-based real estate, these are both areas that are poised to have an enormous amount of growth in the next 10 to 20 years. Real estate and infrastructure we normally associate with something that's a fairly mature industry, something with a stable cash flow. The growth aspect of this means that, you know, in renewables, where we're in a transition economy veering away from fossil fuels and carbon sources to renewable energy, there's an enormous infrastructure that has to be built out. And of course, the tech expansion that we've seen just during the pandemic speaks for itself. Go to the next slide, please, Larry. You'll see a little bit of information on this GRNI, the Global Renewable Infrastructure. So this, like any other infrastructure investment, would have high barriers to entry, great demand and price insensitivity because both price and demand are constant over time. Positive cash flow, which is again what we look for in this type of alternative infrastructure exposure. And very important for us, particularly at this juncture, hopefully not for too long, is renewable or infrastructure in general offers a very good buffer against inflation, and that's because its positive cash flow increases as prices rise over time. So you can actually capture that in a very stable income through this Dow Jones, this Brookfield exposure. The reason I said Dow Jones is we'd already associated with Brookfield in ZGI, our global infrastructure ETF, which is a Dow Jones Brookfield index. So that, having seen what they did with that index, we felt very comfortable going to use them for this global renewable infrastructure exposure. The other exposure I mentioned, if we go to the next one, for those of you who are old enough to remember 20 years ago, we spoke about something called the new economy in the early 2000s. A lot of those elements of new economy are still with us today. Back then, we were seeing an increasing number of mobile telephones being used in different economies. In Scandinavia, it was over 90%. In Canada, we've got some of the best mobile phone coverage in the world. The expansion of internet learning, and if we can have a bit of a chuckle as well, internet dating. I mean, there are everyday occurrences that are now happening more and more online than in person. E-commerce has soared enormously and will continue to do so. Along with e-commerce is this notion of logistics management. How do you get goods from your warehouse to your customer's doorstep? These are all part and parcel of this great second leap forward in technology, looking for infrastructure or physical real estate to help support this expansion. So that's another area where you can look for growth in demand, increased revenues, sustainable income, and of course the great growth opportunities that we need to outperform inflation over time. Now, another area to look at, this wouldn't be strictly income oriented, it would be more growth oriented. We have something called ZINN, which is an innovation index. It actually combines 4 different innovative areas. Automation and robotics, which you can get on its own in ZAUT. Next generation internet, which we've talked about an awful lot, ZINT. FinTech or blockchain, which is of course on the tip of everybody's tongue these days, ZFin. And ZGen, GEN, for genomics. And of course, in a post-pandemic world, we understand how drug development and understanding of the human genome has become far more important in an aging society. Now, what's interesting about these, MSCI built these indices for each of the components, but they've also built this Master Innovation Index, which combines all 4 of these components. The definition of what connotes or designates innovation is defined through ARC, the Cathy Wood and the ARC asset management in the United States. But MSCI takes those definitions and designs a diversified, broadly exposed index. So you don't get the concentration and single security risks that you would get in the ARC portfolios. I refer to these as being ARC-defined, MSCI designed exposures. So for those people who want a proxy for private equity, this notion of high growth through these innovative areas in technology and biotech can be accomplished very, very simply in ZINN. Now, what's interesting, if you look at private equity as an asset class, invariably, if you were to risk rate it, it would all be high risk. Disclosure risk, manager risk, you name it. Here you've got publicly traded assets. You've also got broad diversification. And regulators have looked at this and given it a medium rating. So that gives you an opportunity for a large growth component in your portfolio, something to accent as well as your normal equity, broad equity exposures. Very similar profile to private equity, but with a lower risk format, a lower risk rating, and no liquidity constraints. So, this is just a quick overview of how you as an individual investor can use alternative assets in your portfolio construction to diversify and control risk, to add additional yield, and broaden your prospects in an uncertain time when equity markets are richly valued and we have geopolitical risk and people are looking to add more and more income. So I hope that's helpful.
I think so, Mark. These are 2 great ways to get access to these alternative markets. There's not a week that goes by on BNN that we don't get a question. My traditional fixed income isn't giving me, but here's the key thing. People are looking for ETFs and these alternatives. The volatility of some of these alternatives are very different than a traditional fixed income instrument would be.
So they're low, often low correlation to both fixed income and to equity, and that's where they fit in as lovely portfolio diversifiers. The Pension Investment Association of Canada, PIAC it's called, shows you their overall asset mix they've got over 140 members in Canada. And the weighted average for their plans is roughly a third equity, a third fixed income, a third alternative. Now they're different because they don't manage assets, they manage liabilities. And they have very, very defined distribution requirements to pay their pensioners. I wouldn't suggest you go 1/3 alternatives, but certainly looking at 10 or 15% in a portfolio, lowering some of your fixed income, definitely a worthy consideration inside of your own.
There are two charitable foundations that I sit on the investment committee, and for the last 2 years, every meeting is full of what do we do about that traditional bond part of our portfolio that frankly hasn't been working for years for us. And as a fiduciary, when you look at it with that lens on, it's a very different world. The need for alternatives are growing and growing and growing. And as you correctly stated, these pension funds and that have these long-term obligations are looking at these alternatives. Tell us a little bit about the ETF webinar tomorrow.
I'm not sure about you've caught me unawares.
Okay, no. Well, spring into ETF investing. So the Friday ETF webinar that you don't know anything about, which is great. Obviously, you're not on it this week, but I will be a guest on it.
I was invited.
In fact, the 1 week that I had COVID where we had to cancel, we're replacing that rather than continuing next Thursday, and I had a previous obligation. I'm going to be on one of the Friday BMO webinars at the end of May. So stay tuned for that, and we'll certainly put out some more information. But these weekly webinars that follow ours, Thursday night webinars, are chock full of education and ideas, and I would encourage everyone, if they can, to tune in. So Mark, thanks so much for your time tonight. As always, great to see you, and enjoy the left coast weather as it starts to rain and we start to get the warm summer.
Thank you very much, Larry.
Have a great week, Mark. Bye.
Bye-bye.
Okay, so as a reminder, folks, our educational efforts on the Berman's Call YouTube channel, you'll see copies of these webinars, our weekly updates that we've been putting out on the weekends, and everything else we do going forward in terms of education. So with that in mind, I'm going to ask Cynthia to jump on here as we get into the next phase of our talk tonight. So from CMLS Asset Management, the Director of National Investment Sales. So Cynthia here is been with CMLS for several years. I'll let her kind of briefly introduce herself that way. I met Cynthia, about a year and a half ago was maybe our first purchase. So in the private credit fund tonight, I'll talk a little bit about that I run for our Q Wealth Partner platform. We are invested in this CMLS fund. We're going to talk a little bit about one of the reasons I wanted to bring Cynthia on tonight. Many of the funds that we buy are not open to individual investors. you actually have to work with a financial advisor to do it. And given that the vast majority of our audience is of the do-it-yourself kind, they always want some choices. So ETFs are out there, and you can have a look at some of those. And then, so Cynthia, welcome. Why don't you tell us a little bit about CMLS and what you do there?
Well, thank you, Larry, for having me on and for that warm welcome. So a lot of people know who CMLS is on the lender side, but not so much on the asset management side. So CMLS was founded in the 70s by PH&N. We're now 100% management owned. We have about 650 staff across 10 national offices. And because CMLS is really one of the sort of largest non-bank lenders in Canada, we also have servicer ratings by DBRS and Fitch. So we're not only just sort of one of the largest non-bank lenders in Canada, but we're also the highest rated. So we manage over 30 billion in AUA, and we fund over 14 billion in deal flow. And that would be through our commercial lending business, our single family residential business, and more recently our advisory or sort of investment banking line of business. And really, if I put that into perspective, many of our competitors may fund closer to 2 billion. So we're doing 14. So the deal flow really paired with our infrastructure is unparalleled. So we really want to be known as your the most comprehensive full service brokerage in Canada. So that's who we are sort of at sort of top level. And then you've got CMLS Asset Management, and we're a subsidiary of CMLS Financial. And if you wanted to jump into it, we can kind of just get right into the fund. And on the next slide, Larry, 12 years.
Before we get into the fund, I do want to talk a little bit about fixed income in general, and more traditional fixed income and the inflation. And I promise you, we will dig into your fund quite a bit, for sure. But I get a lot of questions recently, and there's a lot of talk about the yield curve inverting and what are the odds of a recession. And I ask this because one of the things that you do and why we invested with you is your asset class in lending to secured mortgages against people's homes that they live in, and office buildings and other sort of commercial type of lending that's part of the fund. Again, we'll dig into the fund specifically in a little bit. But if we go into a recession, what does that mean? And I've always said, like, you're going to lose your home if interest rates go up too much and you can't afford that mortgage, or you lose your job and you can't afford that mortgage. So what's the probability of a recession within the next 12 months? My favorite indicators are from the New York Federal Reserve. So I put a link on the site here, and you can, it updates once a week, and you can have a look at it. And it looks at the shape of the yield curve. And we all know when that yield curve inverts, that's our telltale sign that a recession's coming. And you can go back and look at, post World War II here, and of course the high inflation of the 1970s, and see when that yield curve inverted, when that black line starts to move up, that means the probability of a recession is pretty high. So, from this lens, we're not there yet. And if we do get one, actually, President Biden said today, well, I don't see one coming now, even though today's GDP print in the US was negative. Sometime next year, maybe 2024, depending on what happens policy-wise, but probably a recession coming. So question for you then, what happens to your investors when people start losing their jobs and can't afford their mortgages? Can you tell us maybe very quickly, how does that work?
So if I was going to just talk a little bit about where we're going to focus on the single family mortgage side, we're looking at borrowers who, the idea generally for us is to graduate a borrower down to a lower cost of capital. So we're going to take someone who, let's say a surgeon, for example, who's out of school for 12 months and needs 2 years work experience to be able to qualify for that bank loan. Right. What we'll be able to do is write a 1-year loan for that borrower, And this person's going to look like a good credit score. This is going to be a property that's probably in Toronto or Vancouver, and average size of that loan is probably going to be around 500K. Now, keep in mind this is their primary residence, and when you're thinking about
so you're not lending to second homes and vacations, and this is people's primary residence, but for whatever reason they don't qualify for a traditional bank loan.
Correct. Yeah. So we'll write them a short-term loan and essentially graduate that borrower down to a lower cost of capital loan. So your CMHC insured loan, for example.
Okay, great. So, but loans, like, give us an example, say during COVID. What happened then? Because people were losing their jobs, they weren't working, their incomes were impaired for a little period of time. There must have been some of the loans that you put out that people weren't paying for a period of time. How did that all work out?
Yeah, so we had actually 2 properties that had gone on our commercial side that went into our deferral program, and all those ended up.
Two out of how many loans overall?
I would say about 150 at the time.
Oh wow, so very little.
Just speaks to our credit and underwriting process, really. So the NAV would have been written down to 9.91, where usually it's sitting around $10, and really at the end of the day, the NAV ended up creeping back up to $10 where it should be. But if you think about this portfolio, we're holding these loans. We're not looking to essentially own these loans, right? So this is just a short-term loan that we're going to have on the books, and a borrower is going to come to us and need it for like I said, less than a year, and typically that loan will roll off at the end of the day.
Right, but in the case where there's an impairment, you could take over the property, you could find an alternative lender. Usually there's a lot of equity in the property. Can you talk a little bit about what loan to value is when you're lending?
Yeah, so our LTV is quite low at 61% right now. So that just creates a bit of a cushion. So if there was sort of a downside, it takes away some of that downside risk.
Right. So if you had to foreclose on their mortgage because they couldn't pay it and sell the property, that 39% on average is a great buffer.
Mm-hmm,
so the odds of losing money in this type of lending aren't zero, but really low. And folks, this type of lending to individuals against their home in the private lending space of secured lending is one of the safest things you can do. And not if it's one loan. One loan, one property, one house, big issue. Big diversified pool of mortgages, couple of them go bad, it's going to happen because as you go through the economic cycle, but diversification is pretty key here. So, moving on, I showed this chart on the show this week, and it's a long-term trend falling of 30-year interest rates in the States. And I highlighted these 2 ranges because, as the dot-com bubble burst, 20 years ago now, plus years ago, and the markets sold off, bond yields went down. And we sort of stabilized for a number of years going into the great financial crisis with long bond yields in and around 5%. And back then, inflation was still running 2%-2%-ish, that Fed target that they talk about. And the bond curve was normal, right? You had yields at a higher rate. And really ever since the great financial crisis and then Brexit, and then there's a European crisis in 2011, 2012, and then Brexit 2016, to collapse the oil prices 2015, there's always been something. And of course, recently COVID, we had this kind of second range. And so over the last decade or so, the average long-term bond yield was around 3. And I asked the question, what would happen if mortgage rates went from what we're used to, where the vast majority of people who own homes today have financed at a certain rate, if we go back up to that old rate? And to me, the economy would fall apart. There's so much leverage in mortgages and everything else. So, if interest rates went up, here's the question for you, Cynthia. If interest rates went up, what happens to your portfolio?
Yeah, so we've seen that over the last few months here alone, and I can talk to that when we get to some of the slides that we have here, is that we've seen sort of a bit of an uptick here in March when I compared to January and February's performance. And again, it goes back to the quality of borrower that we're lending to and the duration, right? And so with the rates rising, we're going to see essentially our fund take advantage of that. With these sort of lower risk borrowers.
Right. So normally when interest rates move around, the bond prices go up and down. But because your loans are typically a year or less, you don't see that. It's kind of like money market. It's kind of like issuing a money market loan in the sense that it's only a year term, but you don't get the fluctuation in price that you would, with traditional fixed income. So that's an important point to definitely drill home here when you're trying to make a distinction between traditional fixed income lending and the price volatility that you see with it and the experience you get with these private type mortgages. Here's an example of the US yield curve, and the orange or yellow line there is the yield curve in the US to start the year in 2022, and then where it is today. So as inflation has picked up, we've seen this dramatic turn in interest rates and the expectations for the central banks to get very, very aggressive in raising rates. And you'll all know next week is we hear from the Fed, they're going to probably do a 50 basis point rate hike. They're probably going to set the path for a much more aggressive rate hike cycle. And so as your loans are always rolling off, you're resetting them, and you're resetting them typically, at a higher coupon, right?
Correct.
Terrific. Okay, so let's have a look at 6 different ETFs that represent different types of exposure in the public market. And one of the things that Mark from BMO was saying was that you have liquidity. Absolutely. So you have a lot less liquidity with funds like yours, and we'll get into that in a minute. But in the public market with an ETF, you can trade intraday and all day if you like. But that liquidity gives you the volatility of prices. And I started saying shortly after Brexit in 2016 that the 60-40 portfolio was largely broken. And in the last 5 years, where we see all these metrics of fixed income here, and we look at the annual total return, and whether you're looking at the broad Canadian bond market. So on average, that 40% of your portfolio for the last 5 years has given you an average annual return of 0.56%. If that was in the global bond market, AGGG, that trades in London, that's the entire world of fixed income. You've lost money, never mind inflation. Okay, that's a whole other thing. The entire US bond market, a little less than 1%. International bonds and currencies play into this, currency movements. Emerging markets have lost you money, and EMLC, the one that I talk about a lot, has lost you money the last few years. I still like it for its yield, but the currency part and the capital side has not done what I've expected. So you've got the entire world of fixed income for the last 5 years, terrible. On a year-to-date basis, this is the worst start to the year for traditional fixed income since the early 1980s, when Paul Volcker, running the Fed, had to break the back of inflation with aggressive rate hikes, not like the Fed is going to do now. They were far more aggressive, and inflation was far more dug in. But he broke the back of inflation, and really bad for bond investors. But for investors in strategies and products like yours and the private lending markets, I can't emphasize enough that you don't experience the same price volatilities as the public markets do as interest rates move around. There are still credit risks, meaning risk to that asset class in general. as that creditor, that borrower that you're lending the money to, loses their job, can't pay for some reason or whatever. So that's kind of the overage of the conventional bond markets. And again, that question that comes in every week on BNN is, Larry, my bonds aren't doing it for me. You know, what do you suggest? And you can go to equities and real assets and infrastructure like Mark talks about. There's some volatility there. If you're looking for stable, safe, not risk-free, but safe, and a good yield higher than the rate of inflation, you've got to look to some of these private lending markets. So you've got this area of investing where the banks just don't like to play. And they don't like to play because that doctor you talked about that just graduated, that doesn't have enough time and doesn't have enough income experience, they just finished school, but maybe they have a bit of family money, somehow they're going to pay that mortgage. They go to a private lender like CMLS, and they're going to have to pay what, 7-8% for a mortgage, something like that. Tell us a little bit about that.
Yeah, so as you were just saying, I mean, that borrower is going to come to us and we're going to essentially bridge them down to walk them through, I guess, a situation, like as we were just describing, right? So we're going to lend them a little more expensive debt, so 5, 6, 7, 8%, right? And the idea is then once they get sort of their ducks in a row and they're showing that sort of 2-year work experience and they've worked out whatever situation it is that we're trying to get through, we can graduate them down to that lower cost of capital and that CMHC insured loan. And that's why our duration will stay so low. And that's on the single family side. And of course, we have the multifamily side of the portfolio. And if you want me to jump into that, I certainly can give an example of what that looks like.
We'll get into that. I wanted to, the other side of the private credit side is lending to small and medium-sized business. So you have the real estate side. We're going to talk about those two aspects of what CMLS does tonight. Folks, there's many aspects of private lending. In the fund that we run, so the Q Wealth Private Debt Investment Policy will allocate between 10 and 40% to the private residential mortgages. We feel and believe that that's the lowest risk category of lending. CAIA, C-A-I-A, is the Canadian Association of Alternative Investments, and AIMA is the US version of that, and they have some guidelines around risk levels in these private credit type lending. And these senior secured loans, secured against the value of the property, senior meaning your first loan versus second or third, is classified as low to medium risk. And when you compare that risk and the volatility of that risk with traditional higher yield type lending to corporates, and the volatility and drawdowns that you see in portfolios, comparing that to the private lending markets where the drawdowns are smaller, the volatility is less, you've got a very compelling solution for individuals. Now, the challenge is not all these funds, there's 40 funds that we're invested in. The vast majority of them, they don't take individual investors. You either have to work through a financial advisor or you have to be what's called an accredited investor. Can you talk a little bit about what that means, Cynthia?
Yeah, so an accredited investor is going to be an investor who, has assets that would exceed or equate to about $1 million. And this fund, we've made it a little more accessible for other investors to participate, and that would be called an eligible investor. And an eligible investor would earn $75,000 for the last 2 years, or together with their partner, they would own they would have $125,000 that they've earned over the last 2 years as well. So there are limitations with an OM eligible investor. They can only invest up to $1 million or $100,000 in 1 calendar year.
Okay, great. So again, opportunity for a lot of the do-it-yourselfers out there. If you don't want to work through a financial advisor, that you can reach out to CMLS and Cynthia and her team, and they can help you in this area. So the other areas, we'll touch a little bit on commercial and offices and multi-residential for CMLS, but then there's the development mortgages. We're not going to touch on that tonight, but that's where you're lending money to a condo build. The banks will get into that space and lend at traditional rates once that property is 70 or 80% leased. But until they know that that money is going to come to buy all those condos and offices and whatever happens to be building, there's that market where the banks just don't want to play. And this is where these private lenders come in, and they can, in the development mortgage space, can get yields between 10 to 20%, depending on the quality of the builder, the location, different economic factors, and so forth. So there's significant yield to get in some of these other markets. And I've ranked these by way of risk category. So the lowest risk, low risk, moderate risk, and highest risk. And so the private lending markets, the lower risk aspect of that, we'll talk a little bit about that tonight in another fund that we're going to feature. And then some of the higher risk areas, again, we're not going to concentrate on tonight. I could probably spend 3 or 4 hours in this topic alone, driving through, and obviously we don't have that much time tonight. So Cynthia, again, we covered a little bit about who CMLS is, and what they do kind of off the top. So someone's asking, here's a quick question that came in. It says, confused, what does this mean and why do they offer CMLS? So Lawrence, I'm not sure exactly what that question means. Maybe you can clarify it a little bit. But CMLS has a fund, and we can talk about this, that individual investors can get into. So why don't you tell us a little bit about the fund, a little bit about the track record and the focus here, Cynthia?
Okay, great. So as you can see here, we've got a 12-year track record, and this was a fund that was initially created as a vehicle for our management team to invest alongside some of our institutional partners, which will include some of the largest wealth and asset managers in the country, including some of the top 5 banks and entities such as CMHC, for example. And really over the last number of years, investors have been looking for a way to diversify their fixed income portfolio, as you were talking about earlier, and generate those equity-like returns without jeopardizing capital preservation. So we've been doing this for about 12 years for our management team and friends and families and partners and the like. And in 2020, or just around the end of 2019 or 2020, we started to expand this offering to outside investors and portfolio managers like yourself, Larry. And this is really something that I'd say that we've been doing on behalf of our institutional partners for 45 years. And really all that we're doing within the mortgage fund is taking this package of services that CMLS Financial, as our parent company as a whole, will offer, and that's our origination, our underwriting, and our servicing, or monitoring loans throughout a loan life cycle. And we've refined these services over the last, like I said, 45 years, and offer it to investors who we typically haven't offered it to. So, it makes sense when we're talking to some of these institutional investors or, pension plans, and they'll come to us and they'll need, let's say, $1 billion of commercial mortgages. Well, we can certainly do that for them on a one-off basis, but we realize there's this whole market of investors that have between tens of thousands to hundreds of thousands of dollars, or millions even, who just haven't had access to this type of product. So all we're doing is wrapping those services that I just previously mentioned, our origination, our credit and underwriting, and then our servicing, and wrapping it up in a pool and adding a cash distribution to it. And we're going to target between that 5 to 7% each year, as we have for the last 12, and we're going to do that with low volatility assets. That's essentially what we're doing within this fund.
Okay, perfect. So Lawrence was asking again, So you mentioned a limit to people who don't meet the accredited investor. So as an accredited investor, you have to have $1 million in assets and income, family income over, what is it, 200,000, something like that?
It would be over 200,000. Yes, correct.
Right. So if you meet the accredited investor, is there a limit to how much they can invest with you?
No.
No. So for investors that don't meet the accredited investor rules, these are rules put out by the regulators. They're not Cynthia's rules. They're not Larry's rules. These are broadly defined rules across the country and apply to all kinds of funds that are not offered by full prospectus, right?
Correct.
So full prospectus, like a mutual fund, open to the public. These are offered by an offering memorandum and therefore subject to some of these rules. So if you don't meet the income and asset test, you're limited to 100,000. But if you do meet the accredited investor, there's no limit to how much you can invest. And as Cynthia said, 5 to 7% target, capital preservation is a major focus. Let's have a look into the fund and see what types of lending you're doing. You mentioned individual households. So that's single family. So 2/3 of the fund would be loans to people against the homes they live in. Tell us about some of these other asset classes.
Yeah. So this was the stats were as of March 31st. And so in terms of the other asset classes that we're primarily focused on residential real estate. So you'll see 67% is that in that single family, and then you've got 28% in multifamily. And that for us is really a strategy that we operate, that we have been sort of operating for the last 45 years. And it's like a value add play. So it's similar to what we're doing on the single family side in a sense that we're trying to, take a borrower in a certain situation and graduate them down to a lower cost of capital. We're going to do that, let's say, on a multifamily building that has been, Mr. and Mrs. Smith own it. They've had it in their portfolio for a number of years, and it just hasn't gotten the right, attention that it needs. And rents, let's say, are $1,000 a month, and so that's significantly below market. And in order to bring them up to market, some sort of improvement needs to be done to those units. So we're going to renovate the kitchen, redo the balconies or what have you, increase the NOI in some capacity, right? So we're going to lend, say, a borrower who goes in and buys that multifamily building, to your money and offer flexible payment terms. They're going to go in, they're going to renovate those units, bring them up to market. And once those units have been brought up to market, we're going to take out, that entire sort of debt stack and graduate them down to a lower cost of capital on the CMHC insured loan, right? So these are all going to be second priority loans. And the strategy is that we'll use institutional money on the front end for the first, and we're going to take a small piece of the second and place that into the trust with the clear intent that there is that exit strategy in place.
Right. So slightly that boosts the yield a little bit to the fund.
Correct. And I would almost argue that, some of our seconds would be safer than some of our competitors first that may be on, say, a land and construction deal, or what have you. This is something that is income producing, and it's a real tangible product.
Right. Again, emphasizing the security of the property is really important. So right. 77% are first mortgages. Loan to value, we talked about a few minutes ago, but 61%. So 39% on average of the value of all the loans outstanding are equity, meaning if in a terrible situation, CMLS was forced to liquidate the property to get their money back from the loan, that the first 39% would be on the homeowner in terms of the risks. So you're great coverage. And again, all of these 172 loans, every single house would have to stop paying, and you'd have to foreclose on all of them and sell them for an average of more than 40% below the current appraised value for the unit holders to really start to lose money. That's essentially what it is, right?
So yeah, absolutely. And then I just wanted to talk a little bit to that priority is all of our first priority loans would be your single family detached home. And then the second priority loans, so that 20% piece there is going to be that multifamily strategy that I just sort of walked through.
Right. And mostly in Ontario, BC, and then scattered amounts throughout Canada. So that's kind of the exposure. Term to maturity 0.82. So that's 0.82 of a year or a number of months. Yeah.
Yeah, so we're inside of a year, which, you know,
Right.
I would say having that low duration allows us to be a little more tactical. So for example, you know, leading up to 2020, no one knew that there was a pandemic that was going to come across all of us. And having that shorter duration allowed us, like as a firm, we wanted to move in the direction of being more focused on residential, real estate in general. So you know, having that lower duration allowed us to be more tactical. And say if we had these, you know, 5-year loans on our books, it would have been, you know, much harder to be able to make that transition. And we were, you know, well positioned as we were heading into that pandemic. No one knew about.
So we had talked about liquidity. A question came in about how can someone get their money out, because you're giving up the liquidity of the public markets. And so I know once a month you can buy your funds. They're available monthly. How does a redemption work if someone wants their money back?
Right. So this fund, I would say, is for somebody who's looking to protect a nest egg and see it grow in sort of a measured way. So this is not a short-term trading fund. This is somewhere, you know, people will come to me and let's say it's a grandfather who's got like a family trust for the grandkids set up, right? This is your sort of 3 to 5 year money or your sort of forever money, I'd say, right? They can certainly get their money back. And within the first year, if they do redeem, there's a small 1% fee. That fee goes back into the fund for the unit holders. Again, it's just to sort of discourage redeeming and using this as a shorter term vehicle.
Right. So that's a very important thing, folks. The liquidity that you're giving up in an asset class like this for the safety, for the lower volatility, typically ties you in a little bit longer. You can get your money out, but again, there's an early out fee if it's less than a year. They don't want you using this as a money market account while you're waiting to buy your stocks. That's not what this asset. You need that. That's where you don't have a lot of choice and you got to go into the public markets. Again, as Cynthia says, this is for stickier money that's looking for that safe yield that would replace a part of your portfolio that would traditionally be traditional bonds and fixed income. Great. Okay. And so the best part of all of this, I mean, it's all good, but look at the monthly returns over history and you can see the consistency. Not every month, it's not 6.2% and every month you get 0.5. It varies a little bit. Talk to us a little bit about the variability, but look at the consistency. Look at what happened during the month of COVID in March of 2020. So talk a little bit more about that. You mentioned the NAV moves a little bit, but really outside of that 1 month, in the worst possible thing that could happen to the world, theoretically, maybe outside of a nuclear disaster, where, you know, the stability is there. You get a pretty consistent coupon every month.
Yeah, so we follow IFRS rules. So we fair value our mortgage portfolio each and every month. And we actually have a group that does that, which is unique. And it's actually a service that we provide to some of the larger banks, is our Intellify group. And what they'll do is they'll probably evaluate probably north of 40 billion of loans. So they do this again, so for some of the top 5 banks, and they would do this for our loans as well. And what happened in 2020 was we took a small write down in March, and that's the only write down that you would have seen here in this chart. And that was because of the valuators applied a bit of a credit risk to the loans in the portfolio that had gone into that deferral program. And you'll see that the next month it just came right back up. And then again, to your point, Larry, what we were talking a little bit earlier about the NAV being, or the distribution changing just a little bit month per month. And you're seeing that because rates certainly came in 2020, 2021, they came in for everyone. And now we're just starting to see that creep back up, and you'll certainly see that in the performance for March, as it's a little bit higher than February and January trended.
Right. So I look, my eyeball looks at a big number and a little number, and I see 0.82% in August of 2020. Was that recapturing some of those loans that you maybe had to write off the few months before?
That would have been that, yeah.
Yeah. Yeah. So that's kind of, the nuts and bolts of it. Question came in as well. How much does it cost? What is, if an investor came to you, Cynthia, and said, I want $1 million of this thing tomorrow, what would that conversation look like by way of management fee?
Yeah, so our fee is quite competitive. So just 1%. And there are no performance fees on top of that, where some managers, if they hit a certain thresholds, they might charge a performance fee. We're not doing anything like that, so you're not going to get hit with any surprises.
Right, and so these are eligible for TFSAs and RSPs across the gamut of accounts. Are there any accounts you can't hold this in?
Yeah, no, as you see, you can do your registered accounts. You can't do it in a RIF. But another thing that we offer is, you can purchase this through your a core.
A LIF or a RIF, because you've got RIFs on here in terms of being okay. So I'm just
sorry, the LIF. Yeah, sorry.
The LIF, the locked-in funds are not eligible. Okay. Okay, so that was another question that came up. So we answered that one. Great. Okay. Any other ones that come here before I jump to the next subject in the private credit? Where can you buy them? Lawrence asks. So how does someone get in touch with you, Cynthia?
So they can reach out to me directly, either email our general inbox at CMLS.ca, or you can, reach out to me. I think Larry, you might have the contact details within the replay here.
Someone's asking about drips. Yeah.
So there's two ways in which you can receive your distribution. So you can either take that in cash each month, or you can have it reinvested units. Perfect.
So really, you got all the flexibility that any type of fund would have, and the benefit is you got 6%, 5 to 7% target. You can see there's variability over the years as interest rates may go up and down, but long-term number right around 6. So great.
Yeah, it's that safe, stable return and capital preservation really are some of the biggest takeaways, I'd say.
Yeah, another question, are these performance numbers before fees or after fees?
These are net
of fees. After, right? Net of fees, right? So the fund is earning on average 7-8%-ish in that range, and then there's the management fee and some cost of administration and things like that. But these numbers are net to the investor.
Correct.
Great. Okay. So now I'm going to get into the next fund that I featured this week on BNN. And Cynthia is not an expert in the private credit area. It's a very different type of lending. And I featured the Next Edge fund, but I wanted to show by way of comparison, looking at this asset class and what this fund has done, and you can see a very similar pattern in the consistency of monthly payouts. Why? Because it's lending, right? This is not equity risk. This is very, you're giving someone money and they're paying you interest. And the only time you have a problem is when they don't pay. And then there's rules that all these companies have to follow in terms of, how they calculate what the net asset value is and so forth. And you can see here during March, April, May, June, that monthly payout went down because there was probably a handful of loans that Next Edge had in this fund that were deferred. I mean, the world stopped for a few months. So, and then ultimately those numbers came back, and the year overall was still around 7%. So, again, this type of lending is a little bit different. Put a link there. You can go to their website and check it out. But here's a fund where individuals can't go to them. And one of the reasons why I didn't bring them on, because I asked them to come on, they said, Larry, you got to go through a financial advisor. We don't sell it. We don't deal with individual investors. So CMLS has a slightly different model. They deal with advisors and they deal with individual investors directly. And you'll all be very lucky. You'll get to deal with Cynthia just like I do, and she's wonderful. Okay, so Next Edge. This is a very, very interesting and unique fund, but this is lending and different types of lending to small and medium enterprise businesses, typically businesses that don't fit the bank model for whatever reason. So banks don't like to do certain types of lending. They don't understand the business. They don't like lending against income. They much prefer lending against stable things that they can sell if they need to. So again, it's the business development bank model developed in Canada going back to the Great Depression. In 1980 in the US by an act of Congress through the 40 Act Fund, they created these public BDCs. And the goal here was to lend to the areas so that it creates GDP and growth that the traditional banking world doesn't fit in. The cost of capital goes up. So you're able to generate higher yields and returns, but the risks are all managed. One of the questions, and Cynthia, maybe I'll ask you this one, when I'm doing due diligence on the managers to figure out which are the Cadillacs and which are the funds that we want to invest in, so that when there's a bridging and there's a fraud, we can avoid it. How much of the partner money, of the employee money is invested in the CMLS funds themselves? You don't have to tell me who or anything like that, but some meaningful amount.
Yeah, and I mean that's again goes back to the genesis of this fund, right? We were initially it was pure essentially partner and management money. So I'd say we'd have at the time when I came on board the fund was 20 million. Now we're over 100 and around 130. So that base was essentially partner money, right? So yeah, and then again when you're talking about due diligence, you really want to make sure that the partners that you're working with are they're transparent and they're willing to sort of communicate with you through some of those challenging times, right? Yeah. I'd say that was the most important thing for me essentially when I was working with investors throughout March of 2020 was to we were all that was the highest level priority for us, was to make sure we're communicating with our investors.
The due diligence process of avoiding fraud and it's very, very important. I'm going to give you a book recommendation shortly that I would encourage everybody, if you're going to get into investing in this private space, that you learn about it. You just don't go do it because Larry mentioned it on TV or on a webinar. You got to educate yourself. You got to understand the asset class. You got to understand the risks. But I wouldn't be presenting it to you. I wouldn't have created a fund 2 years ago that focuses on this if I didn't think it was such an important asset class that retirees and people saving need exposure to. So this Next Edge fund, again, available through financial advisors. So for those of you out there who do work with advisors, you might want to ask them about this to see if that's something that you might want to get into. But these guys specialize in 3 different areas. So factoring, accounts receivable. Companies might build up big accounts receivables. They need the cash. They need to buy more equipment. They'll go to one of these private lenders like Next Edge, and they'll say, I've got 10 million in inventory. How much cash will you give me for that? Or 10 million in accounts receivable. And they'll do their analysis on the accounts receivable, how stable it is, the likelihood of recovery. They'll put a discount amount on it in terms of an interest rate, and that will be the rate, and then they will give the lend against that receivable. So And if they don't pay the loan, they then have access to those assets. And whether they're asset backed in terms of receivables or inventory the company has, plant and equipment, things like that. So secured by real assets that are sellable and or liquid that they can then take ownership of. So secured lending, very, very important. And then special situations. So there's all kinds of, consumer finance needs that again don't meet traditional banking models. And NextEdge is a specialist here in Canada that deals with it. So again, encourage you to go to their website. I put the link on there so you can go have a look at that, but you do need to work with a financial advisor to get into the NextEdge fund. So I wanted to, again, now look at the public mortgage investment corp, because CMLS, this fund, is a private mortgage investment corp. You are investing in mortgages. There are a number of public options that they do the same thing. They're just listed as a public company, but they're effectively operating as a business as opposed to a fund. Many of these public companies will have funds that they invest with it also, but primarily and by and large for institutions only, not for individual investors. Everybody knows the name Blackstone. They do private equity, private credit. BXMT is the Blackstone Mortgage Investment Corp Trust in the US. And looking back over a few years, there is an index that Bloomberg created that takes all the real estate mortgage investment trust and kind of does what's that average return. In Canada, many people will know MCAN, MKP, trades in Toronto, and Atrium, AI, that trades in Toronto. Look at the volatility of returns during COVID. Look at the yield that you earn. So potentially you could earn a little bit more in these public companies than you can in a fund like CMLS offers. But what comes with it is the benefit of liquidity, but also the volatility of public markets. And if you're the kind of person that panics and can't stand the volatility, then I would encourage you to seek out Cynthia or one of her competitors, frankly, for that matter. There are a lot of people that do this and do this well. CMLS has a pedigree, 45-year record in the business. Those things really rank highly with me. So that's the Public Mortgage Investment Corp. Then there's the public BDC, the Business Development Corp. BDC Bank of Canada is an arm of the federal government that is funded by the federal government, i.e. the taxpayer, that loans to small and medium enterprise businesses that don't fit into the banking model. So the government of Canada, in fact, is the largest private credit lender. Most people don't know that, but there's a public market too, largely in the US, not in Canada. And there's an ETF that was created a few years ago, back in 2019, VPC, which is an ETF, the Virtus Private Credit Strategy, that holds all these companies that are publicly listed BDCs. And you'll know Bain Capital, obviously Goldman Sachs has their BDC. Monroe is a very, very good operator. Apollo, Ares. So these are all public versions. And again, my emphasis here is really differentiating what your experience is going to be playing these by way of public companies or ETFs in terms of volatility of your returns compared to the much smoother ride that you get and the experience dealing with these private funds, okay? So there was a fraud last year, widely known, called bridging. BNN talked about it extensively. How did that impact CMLS when the bridging story broke? Can you tell us a little bit about that, Cynthia?
Yeah, of course. So it's funny, actually. I was we're approved at a couple of different retail platforms where advisors can purchase the fund. And I was just going through sort of a review of our fund to get our sort of risk rating lowered. And when that news came out, I was literally in talks with getting it lowered. I think it was medium high, just down to medium, where it belongs, really. And I thought, oh, they're not going to do it. now that this has been exposed, which was essentially, fraud and theft. And I have to say, we're just like two different sort of you're comparing apples to oranges here in terms of the pedigree, as you said, with our firm, the transparency that we offer in terms of what's actually in the portfolio. I wouldn't say that a lot of our competitors will essentially, strip out any confidential information. And I would share basically most of the metrics on every loan within our portfolio. And so, did it affect us? No, because inevitably the fund did get lowered. So I think it was just a fear that I essentially had, because it was such a bruise on the, I'd say, private lending, in this private lending asset class in general, right? So for us, no, it didn't impact us. But I think for some people, they hear the bridging scandal and they kind of think, oh, is that an area I want to go into? Well, it really just does come down to who your provider is and the trust that you have and the trust that they should earn from you.
Yeah, I remember last summer I was golfing with a friend of mine, and he said, Larry, did you hear about this bridging thing? I said, oh yeah, I have a private credit fund. We avoided that. I said, why do you ask? He said, my advisor put me in it and all of his other clients in it, and how much do you think we're going to get back? And I said, well, what I heard at the time was, something like 50 cents on the dollar, and it probably takes several years for it to clear the courts and bankruptcy trustees and everything else that needs to get involved. There were a couple of the funds that we were invested in at the time that had some exposure to bridging, and they've recovered most of it. One of the funds had to take a loss, actually. One of the funds we were in that had a loan out to bridging and part of a deal that they were involved with, and they had to take a loss, and so it took a hit to the NAV, and so that year that it gets reflected, you don't get 8% that year, you get 5 or 4. So these things happen, but I think so diversification is important. So speaking about fraud. So folks, this is a book I read recently about this asset class. So David Einhorn's an activist investor. He runs a firm called Greenlight Capital, well-respected pedigree on Wall Street. He was speaking at a charity conference called the Sohn Conference. I've actually been to it in New York. Great event. And they have all these top speakers, and they all get up there. It's all for charity, and they all get up there and they give their best idea. And his best idea in 2002 at this event, that wasn't the one I was at, was to short sell Allied Capital. Allied Capital was the Wall Street darling in the private credit space. They could do no wrong. They were generating 8, 9, 10% a year for clients. Boom, 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 boom. And he looked through it and he figured out that there was some bad lending going on. There was some fraud. There were some government programs they were taking advantage of. Fraud sometimes is very hard to detect. The regulators missed it in the case of bridging. The auditors missed it. When the smoke clears on all this, it'll be really interesting, and there'll be a book written like this. But this book was written about a fraud, and I want you to read it, and I want you to understand what could go wrong here. And this and a lot of other things is the reason largely why when we looked to this asset class and to deliver it for the clients of ETF capital management and the Q Wealth platform of companies that I'm involved with, and as a sponsor of our event, I should say that. So we launched this private debt and equity fund, and the debt side that we talked about tonight, that investment policy that I showed you, and those ranges, about 80% of the fund is the debt side, and the equity side is what Mark talked about. It's cash flowing, real estate, public market, infrastructure that gives you a little bit of equity, a little bit of growth, but it's got that yield in it, and it's a really nice combination. And so you get in a fund like this, and you get your diversified 6-7% type yield. CMLS is in this fund, Next Edge is in this fund, and I'm comparing this with a couple benchmarks. Global bonds 50-50 is 50 Canada, 50 US. Public private debt and equity are some of the that public ETF that I showed you just before. So an example of those returns. And you can see the volatility. Now, from when we started the fund in 2020, the public markets have done much better. As the traditional fixed income, you could see since that time has not only lost you money, but after inflation has lost you a lot of money, where this private credit fund that we have is stable, steady Eddie. There's a couple tiny little bumps along the way, but it diversifies you around Canada, international. We're growing the exposure outside of Canada, international in particular. Some of that international exposure right now is in an institutional infrastructure fund that owns wind farms in Australia and toll roads in wherever they are, somewhere in Europe. Anyways, it's senior secured. It's got low to medium risk. It's got low volatility. It's got an average loan term of just over a year. It's really, really a nice mix of all of these things together. And I think it's really important to find the Cadillacs and be in a really good, high trusted manager if you're going to go with one, like CMLS or Next Edge if you're working with an advisor. But there is that risk that one fund does something wrong, not necessarily fraud, but makes some bad investments. The risks are lower lending against a huge diversified portfolio of single mortgages, right? It's not investing in one mortgage and one house, right? That's a whole different risk than a diversified basket. And I can't drill that home enough that diversification is really, really important at the individual fund level. If they're in 2 or 3 deals, if one of those deals can't pay, you've got a pretty significant impairment to the return, to the cash flow of the fund. And so when we looked at funds, we turned down many of them. There's a couple funds new into the marketplace. They had 2 deals in them. Well, if one of those deals can't pay, I'm not saying they would, but if one of them doesn't pay, half my yield is gone. Boom. So again, it's the liquidity premium is earned. It's not for trading in and out of. It's not a money market replacement. It's for longer term, couple of years. You want that coupon. You need money to live off of. You don't like equity markets, whatever it is, but it's meant for, not to trade. And so that, folks, is a, introduction, if you will, to the asset class, to a couple options, whether it's a BMO public version, whether it's CMLS, or whether you want to reach out to one of the financial planners or advisors across Canada in the Q Wealth world. They can get you access to our fund. So with that, we'll get into some Q&A. So let me look at the live questions here. If there's any that I missed here. So covered those, covered that. Okay, so someone's saying RBC predicts a 30% decline in real estate values. This only leaves 9% in the LTV that would be eaten up in the event. How does a 30% decline affect the portfolio and risk rating? So that's an interesting question. So if real estate was to collapse 30%, like in 2 months. It's never happened before, but maybe it takes 2 years. The last time real estate prices fell, I know this because it happened to me, Cynthia. The first house my wife and I bought, condo, we bought in 1990. Many will remember who were in real estate back then, the higher interest rates. I think my first mortgage was 9 3/4. The condo that we bought in 1990, we bought from someone who bought it new in 1988. They paid $225,000 for it because I had seen the transaction records. We bought it just before we got married in 1990. We paid $168. It was 2 1/4, $168. We paid our mortgage. We did our CMHC. We were early in our career. We had our kids. We did everything we have to do. And then I got a great opportunity to go to work in the US, and I always wanted to work on Wall Street, and that was kind of my dream. And in the mid-1990s, we sold that condo for $138,000. Real estate prices can go down. Most people who invest in that, only real estate goes up. So RBC might be right. They might not be. I don't think anyone can predict it. I've seen predictions for more than a decade now, every year from somebody different, that real estate prices are going to fall. We do have the setup for it right now, but it's unlikely that it falls all at once. There would have to be a tremendous amount of supply hitting the market relative to demand. But if interest rates go up enough, certainly that curbs the demand side. If everyone rushes for the exit at the same time, if people start losing their jobs, that scenario could play out. But in the great financial crisis, broad US real estate prices on average, I think, fell about 25%. So, maybe. But Cynthia, again, question to you: what happens? How does that work out? Every couple of months, a few more people can't pay. Just talk a little bit about that. I'm not going to hold you to anything, and I don't think anybody listening, but it's a great question to think about.
Yeah, I'd say we're mitigating some of that risk on the single family side. There isn't a loan that is so overweight in the portfolio. Again, it goes down to your diversification, right, Larry? So with 75 loans in the portfolio, we don't have anything that, if we were to take a loss, it wouldn't meaningfully blow up the fund or impact the fund in a meaningful way. And I'd say another thing is that, our loans are short term in nature, right? So that might be, more of a challenge for a portfolio that would have longer term loans on their books, but being inside of a year, and then just again going back to the type of borrower that we have within this portfolio and the strategy behind that. I'd say we're doing, our best to sort of mitigate some of that risk.
Yeah, no, I would tend to agree. And again, out of the 172 loans, every single one of them would have to default. You foreclose and you got to sell all those properties out at 39% below value on average to really take a meaningful, hit to the value of the fund and the yield. And
yeah,
so,
and even if I look at some of the mortgage presentations that come across our, credit and underwriters' desks, I mean, these are, 25-page write-ups on each and every deal within the portfolio. So, the due diligence that we're putting into our credit process is robust, to say the least.
Hey, Larry, loved your story about the 90s. Do you remember the term jingle mail? Jingle mail. I'm not sure. Jingle. No, I'm not. Randall, I don't know the answer to that. Hey, Larry, are low vol min ETFs a good investment now? So I'm not going to give you that question, Cynthia. I know that's not your wheelhouse. When you look at factor-based investing, and we've talked about it for years, low vol or min vol is a factor. And when you go into an economic slowdown, typically low vol or min vol are less economically sensitive. it doesn't mean they'll go up if the broad market falls. And because of the risk-off nature of the environment we're in, it's not a cheap asset class, meaning that sector, low vol or min vol, is actually pretty richly priced at the moment. So it's better than a lot of things, you know, but yeah, probably doesn't go up if the market goes down. So, you know, good question. Anyways, as I look at the clock here, I see it's 8:29. You know, we've got a minute left, so I'll wrap. And Cynthia, I'll thank you very, very much for CMLS's partnership with us. We've really enjoyed the relationship. For CMLS's philanthropy, you know, wonderful. And thank you for your time tonight and expertise. And again, cmls.com.ca is .ca?
CMLSassetmanagement.ca.
Assetmanagement.ca. And you'll find, type Cynthia Maisonneuve, you'll find her on the internet. You know, just reach out if that's something you're interested in.
And Larry, thank you for having me on. It was a pleasure to be on your season finale here before you break for the summer. And thanks for the viewers for tuning in. I know there's a basketball game on tonight as well. So
right, go Raptors, go! And so, folks, again, with philanthropy in mind, please reach out to one of our charities. Make the donation through the links we sent out. I match every donation. Thank you.
Thinking about doing a bit of spring cleaning to your investment portfolio? At ETF Market Insights, we got you covered. Check out these exciting episodes curated specifically for the DIY investor. Special guest speakers and insightful industry experts will provide you with the information and education you need to confidently manage your own portfolios. You won't want to miss these shows. Check out etfmarketinsights.com for more information. And don't forget to subscribe to our YouTube channel and hit the alert button so you never miss an episode.